If you haven't seen our overview video about FHA yet, check it out first. This video is going to use some of what we learned there. With this video, I'd like to get into some of the details that define terms like easier qualification. Compared to programs like USDA and VA, FHA is a little more cut and dry on the details. For the most part, people go for FHA loans because there is some factor which prevents them from qualifying for another loan program. This doesn't make them bad loans by any means, despite how that sounds. This program was created by the US government as far back as the post-Depression era, in part to make sure that people who weren't in the best place could still buy their own homes. But how specifically? A number of ways, but let me give a few examples. Medical collections. FHA is more forgiving when it comes to medical collections on a credit report than most conventional programs. When it comes to credit score, we've already covered this one in the previous video, but FHA allows for the lowest credit scores in the industry. Income history. This one is a little stickier. Generally speaking, lenders are going to want to see that you've been in your job for a while to establish that the amount you have coming in every month is likely to stay the same for a while. FHA-backed loans are more likely to be considered for exceptions to income standards than other loan programs. If it sounds like I hedged a little on that statement, it's because I did. You still need to prove that you should have the money every month to pay your mortgage, but FHA loans might bend a little where other programs would just give a denial. These are just a few examples, but there are certainly others. Generally speaking, if you think you wouldn't qualify for a mortgage, it may be worth looking into now that you know something about FHA loans. A final note, FHA is also much less likely to penalize you for having a lower credit score. The mortgage insurance that I mentioned in that last video is determined differently for FHA than it would be if you needed mortgage insurance for a conventional loan. It gets a little complicated, but basically with a conventional loan, the amount you pay every month in mortgage insurance goes up and down depending on your score. With FHA, it's a fixed percentage of the loan. This could benefit a borrower in some specific credit score ranges who's making a low down payment, even if they would qualify for a conventional loan. But it's pretty specific to the borrower's circumstances, which is why I always suggest checking with your mortgage professional first. If you have any questions about FHA loans, please feel free to leave them in the comments section or send us an email directly. As always, if you liked the video, please click that like and subscribe button to make sure you're informed of our weekly updates. Thanks for watching!